Did you receive a significant amount of restricted stock units this year? If so, you need to check out today's video to learn its tax implications so that you could avoid a big unexpected tax bill when you file your tax returns in 2023. I'll also tell you an easy way to reduce your taxes if you stay till the end. So get ready to learn some practical knowledge about RSU. Hi, I'm Prudence, CPA and financial planner. I provide tax and wealth strategies to professionals and small business owners so that they can effectively accumulate and protect their wealth and live the life they want. First of all, what is restricted stock unit or RSU? And why is it used? It's a type of equity-based compensation. Other types of equity-based compensation include non-qualified stock options, incentive stock options, employee stock purchase plans, and restricted stock. Companies include tech startups and public companies as well, offer them as part of compensation, mainly due to 4 reasons. First, it doesn't require cash, so it's desirable for startups. And if the company grows well down the road, its equity could be worth many times more. Second, it provides employee ownership, incentivizes employee performance, and aligns the company's long-term goals with that of the employees. Third, it's usually tied to some vesting schedule based on the service period. So effectively, it retains employees. Fourth, it attracts talent interested in the company's potential growth. Since many startups and tech companies offer it, it's almost a given for early employees nowadays. Restricted stock units are different from restricted stocks, which are primarily for company executives. High-level management usually has insider knowledge of the business and as a result is subject to many more regulations regarding insider trading when they sell their stocks. On the other hand, RSUs are usually for regular employees and are part of their total compensation. So it's in addition to salary and cash bonuses. It's called a unit because when they are given out or granted, they are just an unsecured promise of a future transfer. So it's not a stock on hand yet, but they will turn into stocks once vested, usually after a certain period of time working at the company. People also get refreshers, so that the incentive to stay with the company grows with their tenure and extends as time passes. And I will show you an example in a little bit. In the past couple of decades, RSU has gained popularity because unlike stock options, it's always worth something as long as the company is still in business. Here's how it works. It's granted or promised by companies, most likely public companies, to employees. And the employees have to work at the company for some period of time before their RSUs gets vested. After that, they vest gradually over time, meaning a portion of the granted amount will be given out based on the time of service. So for example, Todd is a software engineer. He joined Tugo in 2018 and was granted 4,000 RSUs to be vested evenly over 4 years, so 1,000 each year for the following 4 years. And every year after that, he got a refresher of the same amount with the same vesting schedule. As a result, he had 1,000 RSUs vested in 2019, 2,000 RSUs in 2020, 3,000 in 2021, and this year in 2022, he got 4,000 vested RSUs. And if he leaves the company or gets laid off, he'd lose all the unvested RSUs. Regarding tax, RSU is treated as taxable earned income when vested. That means it's subject to payroll, federal, and state taxes. We will have a more detailed illustration and calculation in a little bit. For simplicity, assume when Todd's 4,000 RSUs were vested this year, Tugo's stock price was $50 per share at the time of vesting. So the RSU's value would be 4,000 multiplied by 50 equals $200,000. Adding Todd's regular salary of $135,000, his taxable income would be $335,000 this year. Now, here's the detailed calculation of his taxes this year. First, payroll taxes include 3 components. Social Security tax, namely 6.2% on up to $147,000 of earned income in 2022, and that's $9,114. Then 1.45% of Medicare tax on all earned income, and that is $4,858. Also, there's a 0.9% additional Medicare tax on income over $200,000, so that's $1,215. And then the federal and state tax calculation. If Todd only had the $135,000 base salary, no contribution to tax-advantaged accounts, and taking standard deduction as a single taxpayer, his marginal tax would be 24%. And since he also got the $200,000 worth of RSUs this year, it puts him directly in the 35% tax bracket for federal income tax calculation. And for the sake of time, we'll skip the state tax calculation here, because each state is different. Washington State, for example, has no income tax. Illinois uses a flat rate of 4.95%, and California has a progressive tax with the highest bracket at 12.3%. State progressive tax calculation follows the same logic as the federal calculation, with different standard deduction amounts, rates, and brackets. After understanding how tax is calculated, we have an excellent foundation to understand the potential unexpected tax bills. In practice, most companies do two types of withholdings: regular income tax withholding for ordinary income, and supplemental withholding for bonuses including cash and other applicable stock-based compensations, such as RSU. The regular tax withholding is determined by the form you submit to your employer called W-4. Based on the information provided on the W-4 form, HR and payroll will then calculate how much should be withheld for federal and state taxes from each of your paycheck. It's usually fairly accurate with a small buffer as long as the information is up to date and accurate. So you don't have to worry about an unexpected tax bill. Instead, you would probably get a small tax refund when you file your taxes. Unfortunately, many people submit the form when they first join the company and never update it. But if they have significant life changes such as getting married or having a baby, that may lead to withholding too much or too little taxes. So remember to keep the information on your W-4 form up to date and communicate that with your employer. As for bonuses and RSU, they fall under supplemental withholding. So the tax withholding would be 22% if the amount is under $1 million and 37% if it goes over $1 million. 22% might cause a problem since many people's marginal tax rate may be much higher than 22%. If you remember in Todd's case, his marginal tax rate was 24% with the $135,000 base salary and 35% when adding the $200,000 of RSU. So that means his company is not withholding enough for his current year's tax liabilities, and he will have to pay up to 13% difference in taxes when he files his tax returns. And here is a detailed calculation of his federal tax liabilities for 2022. So his actual tax due would be $18,846 if he didn't request any additional withholding or make any estimated tax payments for the quarter when his RSU got vested. And we'll talk about how to reduce the taxes in a little bit. The good news is some companies now allow companies to adjust the percentage to be withheld for RSUs. So if Todd had increased it from 22% to 35%, for example, he'd have more than enough to cover his income tax liabilities. However, if he didn't know about the tax consequences of RSU and how it works, he probably wouldn't have thought about doing it in the first place. In addition, there is no automatic withholding for taxes if you exercised incentive stock options, made significant money in brokerage accounts, sold a property, or had income from side gigs. And you are responsible for estimating and paying taxes each quarter. So if you made a lot of money outside your company's compensation, you need to consult with your tax preparer to see if you need to set money aside for taxes or make an estimated tax payment. Double taxation is another reason why you might get a higher tax bill. And it is an error, so make sure to correct it before you submit your tax return. Sometimes when RSUs get transferred from the company's account to your brokerage account, the tax base of the stocks is not reflected correctly and shows zero instead. And you can imagine if, for example, Todd sold 1,000 stocks at $80 a share at the end of the year. Since it's already included in his compensation at the price of $50 per share, the tax basis of the stock would be $50 per share. The increased amount, which is $30 per share and $30,000 total, would be subject to capital gain tax. And you'll be able to see it on Form 8949, Sales and Other Dispositions of Capital Assets, when you file your taxes. However, if the brokerage company recorded the basis incorrectly, the entire $80 per share or $80,000 total would be calculated for capital gain tax. So if you don't correct the tax forms, you'd get double taxation on the $50,000 of RSUs. You have to add your cost basis directly to Form 1099-B to correct the error. And then you should review Form 8949 to ensure that the calculation is correct. You also have to remember that if the stocks being sold are within a year of the vesting date, then it is considered a short-term capital gain and subject to ordinary income tax. So Todd won't have to pay medical tax on the $30,000 of capital gain. However, he will have to pay 35% of federal tax based on his marginal tax rate. On the other hand, if he had already held the stock for more than a year, it would be subject to long-term capital gain, which would be 15% with his income level. The difference would be 20% or $6,000 on $30,000 of gain. So make sure you understand your short-term and long-term capital gain tax rates before selling any stocks. By the way, since Todd's modified adjusted gross income is over $200,000, he would be subject to 3.8% of net investment income tax on capital gains. So this sale will result in $5,640 or 18.8% in taxes if it's a long-term capital gain, and $11,640 or 38.8% if it's a short-term capital gain. But in either case, if he didn't make additional withholding or any estimated tax payments, he'll get a big surprise when he files his taxes. In addition to the $18,846 resulted from the vested RSUs that the company didn't withhold enough for. You might ask, are there ways to reduce your tax liabilities legally? The answer is yes, and the easiest one would be to max out your 401k and HSA contributions. So in Todd's case, he could contribute up to $24,150 in 2022, saving him $8,453 in taxes for that year. If you want to learn more about tax-advantaged accounts, please check out this video. People who have RSUs might also have questions such as, should I hold or should I sell? When should I sell and how much should I sell? Well, that depends on your time horizon, asset allocation, risk tolerance, investment preferences, and tax situation. Each of those topics might worth its own separate episode. If you're interested, please let me know in the comments below, and I'll add it to my to-do list. To summarize, restricted stock units are part of total compensation and thus subject to payroll and income taxes. However, you must check if your withholding is enough to cover your tax liabilities. If you sell RSUs, make sure to understand if it will result in a short-term capital gain or long-term capital gain, because the tax implication is very different. And lastly, when filing taxes, check that the tax basis of the RSU sold is correct on Form 8949. And if all of the above is too complicated for you, make sure to hire an experienced tax professional to help you estimate your tax liabilities, determine if you need to make any estimated tax payments by January 17, 2023, and prepare your 2022 tax returns. I hope today's episode helped you understand the tax implications related to RSUs and inspired you to avoid surprises and protect your wealth. If you liked it, please give it a thumbs up and share it with others. We're also available on your favorite podcast platform under Invest with Prudence. Please subscribe to my channel to learn more tax and wealth strategies to build the life you want. See you next time!